Warnings about the state of the world's economy are everywhere. Inflation, interest rates, energy prices, war, it is all around us. But could financial technology be just one of the keys to helping us get out of this? You don't need to look far to see the sort of trouble that we're in, but warnings don't come much bigger than those from the International Monetary Fund. The IMF has just downgraded its forecast for global growth in 2023, and Europe is now expected to be the worst performing region in the world. According to the IMF's latest report, for many in the Eurozone, next year will likely feel like a recession. Inflation is at record levels there, now its highest since records began in 1997, and sell-offs have smashed stock markets right across the region. The pan-European Euronext exchange is down 17% year to date, for instance. Meanwhile, Fintech has become an increasingly vital part of the European economy. A report by Deloitte for the EU in 2019 called the sector's growth unprecedented. The pandemic fueled that boom further, but things have since changed. In its latest report on European fintech, Finch Capital has a stark warning. Cooling and consolidation should be expected in the years to come, it says. And that includes crypto and blockchain. Now, we spoke to one of the authors of the report, Aman Gahey, earlier to get the lowdown on both the bad and the good. He said the key takeaway from this report is that there's going to be less money coming in to fintech.
Valuations have obviously come down fairly drastically in the last kind of 6 months. More importantly, kind of funding rounds have also fallen from a deal size perspective. We're seeing about 30 to 50% fewer deal volume amounts across the sector. And what was probably most surprising to us was the amount of fintech startups that were created actually peaked in 2018 and have declined by over 80%. And what all this means, I think, for the sector is there's some murky waters ahead, but the amount of capital that is in the market with investors like us and others would probably make for a softer landing than one would imagine. We expect maybe the return to a new normal levels of 2018-19 in the upcoming kind of 12 to 18 months.
So where does blockchain and Web3 fit into that?
The blockchain and Web3 sectors are fairly early stage sectors in fintech. I think there are not kind of many mature companies in that sector. And in general, what we're seeing is the early stage sectors are not that affected by kind of the latest turns, but the other sectors have taken a hit. So in general, you're seeing the later stage, more mature companies that raised at, kind of, let's call it crazy valuations compared to today, being more affected by the macroeconomic kind of downturn, as opposed to early stage companies where I think investors who still have a lot of capital to deploy are willing to be a little bit more patient and see how that matures.
It's not all bad news though, as some analysts like Marcus Thielen of Matrixport have told Forkast we might be near the bottom of crypto markets. So, is there at least some room for optimism in the sector? Finch's report reckons there is.
What's interesting is if you look back to maybe the last tech-influenced downturn, so to speak, in 2001, and more from a fund perspective, the best performing funds were the funds that deployed in 2001 and 2002 across the board. And it is a function of this is a great time to be investing. That doesn't mean it's easy to invest, but it is a great time to be investing because historically it has been proven that the valuations you come in at, the entry multiples you come in at, have a direct impact on the future outcome of you as an investor. So if I was an investor and if I had capital, I'd be in a pretty happy place right now. Where the hairy situation is people who have invested maybe in the last year or 2 years, how do they readjust their portfolios to the valuation adjustments that have happened in the public markets and how they reflect in the private markets?
So what then about the long-term sustainability of all of this?
You will see, regardless of which sector, whether it's blockchain, crypto, or payments, that people want to understand how this business with little bit of capital can be self-sustaining. And so that will be an important check for these companies in the blockchain crypto space that maybe didn't have to adhere to those principles last year, whether they can prove to investors that with a small raise or with kind of minimal amount of capital, they're able to build profitable, efficient business models.
That was Aman Gahey from Finch Capital talking to us earlier. Now, crypto markets have, of course, also been hit hard over the last year, with trillions of dollars wiped out from market capitalization. So what can we expect in the year ahead there, especially for Bitcoin? Well, Jin Chao, founding partner of CVP No Limit Holdings, spoke to our editor-in-chief, Angie Lau, earlier. He said he does see some light at the end of the tunnel.
It may not happen this calendar year, but I do think that we're following very similar trends and very familiar trends with people that have been in this industry for a while. I think are quite calm about what we're seeing because it's what we've seen before. For people who are newer, so similar to guys that got in at the end of 2017 and went through that downward cycle from 20,000 down to 3,000, bit painful. Similarly, for folks that kind of got in third quarter last year, saw the run up to close to 70,000, and then now down to where we are in that 20,000 range, also painful. But again, those windows are generally 1 quarter. If you look at the rest of cycles and cycle on cycle, people are pretty happy, I think, with the results. We're going to continue to see this volatility until there's mass adoption or early mass adoption. And again, based on my prior answer, I say we're a cycle or two away from that. But in the meantime, I don't see any major changes what we've seen in the past. So what I mean by that is generally from a cycle low to a future all-time high. We've seen Bitcoin do that within 18 to 24 months. And so depending on where you think the low is, if you think mid-June or this past June at 17.7 was our low, then I would argue we'll see another all-time high late next year, early into 2024, if prior patterns hold. And it could get a little extended because of the overall macro environment we're in, but I don't see anything that would completely break this pattern that would say, okay, we're not going to see another all-time high for 5 years. I don't think that.
It sounds like patience really could be a virtue then for any of us holding Bitcoin right now, doesn't it? All right, that's it from us. Like and subscribe to this video for more content like it, and let us know your thoughts on what's happening in the comments.